names for you right now. I'll write them
Okay.
down on a piece of paper.
Oh.
I'll send it to you.
Or you can text it, or okay. Yeah, thank you. Okay, guys, we are going to go ahead and get started. As you can see on the screen, we're going to get into chapter 11, and we will also be able to take a look at chapter 13. We'll do chapter 12 on Monday because that really pretty much takes the whole class time, and so I can't cover that along with some of the chapter 11 material, so we'll defer that until Monday. The other thing I want to do is maybe take a look back at Apple's 10-K, their annual filing with the Security Exchange Commission, and see how we look at that information now that we have some more knowledge, or a lot more knowledge under our belt than we did at the very beginning of class. So we'll take a little time to do that. Of course, your financial statement analysis paper is going to be due whatever date's on the syllabus, this last day class, whatever. And so you really, if you haven't already, you need to pick your company and start downloading some information, maybe their 10-K from their investor section of their website, etc. Okay? Any question on that? No? Okay, good. Then if there are no questions, I'm going to go ahead and jump in to the presentation here for chapter 11, stock transactions. Now, stock transactions, meaning that we're issuing stock to the public, means that we're a corporation. And we had talked sometime about the advantages and disadvantages of the corporate form. Advantage, major, limited liability. Okay, the liability of the owners is limited to whatever the investment in stock is. Disadvantages, increased government regulation. Okay, now you're dealing with what? The state to incorporate. You're dealing with the federal government if you're issuing securities to the public through the Security Exchange Commission, Federal Trade Commission, etc. Okay, additional taxes. There is something called double taxation. And what happens is a corporation, since it's seen as a separate legal entity, needs to file a tax return with the IRS. They file that in Form 1120, just like an individual might file a 1040, whatever, right? Corporation files Form 1120, and then when dividends are paid out to the shareholders, the corporation pays tax on their income, and then when dividends are paid out to the shareholders, they pay tax on those dividends. So some people will call that a double taxation issue, and that the earnings the dividend was paid out after the earnings. They paid tax on those earnings. Now when the earnings are distributed to the shareholders through a dividend, there's taxes on that. And then the separation between the management of the corporation and the owners. If you hold the stock in a company and they're getting ready to make a major decision, do they come to you and say, is it okay if we do this? No, it's like watching a sporting event. You say, no, don't put that guy in. And what happens? The manager does it anyway and the team loses, right? So it's sort of that way, that separation between the management and the ownership. And I guess I was supposed to be clicking these as we went through the different disadvantages. Okay, so advantages and disadvantages. Okay, I think this slide is worth seeing just because I'm thinking that many of you in this room are going to be chairperson, probably is a better term than chairman, okay, but chairperson of the board of directors or something, okay, sitting on a board of directors somewhere. Okay, I see you in that position at some point in time. And as a member of the board of directors, you will be responsible for bringing on the executive team, the CEO, okay, the CFO, Chief Financial Officer. And then you're thinking, well, John, why is all of this broken out here where we have the vice president of finance and the financial officer? Well, this is an accounting class, so we're sort of focusing on that part of the organization chart. And so you would have the treasurer. Treasurer is sort of responsible for making decisions as to how we're going to track capital into the entity. And then the controller is really the one that runs the accounting function that we've been talking about so much in this class. So that's the only reason that got broken out. But I see you guys, up here as chairman and chairperson and a member of the board of directors. Okay? In the state of California, by the way, to every corporation must have an accounting expert sitting on their board of directors. Okay, under federal statute, under the Sarbanes-Oxley Act, corporations must have a expert in accounting. Who do you think might be an expert in accounting? CPA. Okay, if you can have a CPA on that board of directors, you're demonstrating that what? You have somebody that is a financial expert. The other thing that the state of California requires is there must be one member of the board who is female and of a particular ethnic background. Okay, so I often tell my students that I was president of the American Association of Hispanic CPAs. It's now called ALPHA, Association of Latino Professionals for America. I don't know why they changed it to For America. It used to be Finance and Accounting, then they turned the F and the A into For America. And I'm like, well, if it's going to be people that are for America and you're talking about Latino professionals, you should go to the Institutional Workers Union, okay, and get a bunch of professionals that are for America there, basically janitors and housekeepers and stuff like that. But they didn't want that. They want to recruit engineers and so forth. So that was sort of when I said, hey, I'm done with this organization at this point. But I would tell those students, hey, study accounting, and you can see yourself sitting in the board of directors as a CPA. The state of California is sitting on that board of directors. Okay, so just a little bit of, structure of a corporation. Corporations are formed under state charter, as we have mentioned, under state charter. Some states have an easier way to start a corporation than others. Delaware, New Jersey are considered states that it's relatively easy to form a corporation. Once you form the corporation, of course, you're under what? The SEC rules, which are the same across, the different states. But forming the corporation can be a little easier in these states. States that are a little more difficult, California, New York, Illinois, states where people want to live. Those sorts of states, Hawaii, are a little bit more difficult than some of the other states where maybe folks would say, okay, well, I don't necessarily want to live here, but I'm going to form my corporation here. Okay? When a corporation pays organization costs, for example, I pay an attorney to help me file different papers to get the corporation started. I hire a CPA, somebody like Danny, to come in and help me to what? Help me to figure out the accounting statements and whatnot that would go in they call it an S1. That's when you're trying to form the corporation. There's certain financial reports that you have to issue to the SEC. That money that you spend in organizing the organization is an expense. What does FASB tell us about? You're saying, well, wait a minute, why doesn't that have future economic benefit? You had to pay that to start the company. What does FASB tell us? If we don't know if something has future economic benefit, we do what? We expense it, right? And most startups do what? Crash, don't they? Okay, so FASB says, hey, we can't have a company, starting up company going spending all this money on a bunch of stupid ideas, treating them as an asset, making investors think, oh, here's all this future economic benefit. Meanwhile, they're maniacs, and they're not necessarily going to have something that's going to have some future economic benefit. So all organization costs are what? Expensed. Okay? Okay, good. Now, what are some of the issues that come with stockholders? You have the right to vote. So even though we saw the high levels, the CEO, the CFO, high levels within the organization, they are what? They're the person holding their leash or their chain. They are responsible to what? The shareholders who can vote them out if they don't like. Now, there may be some time before you're able to cast that vote, but you can vote out members of the board of directors and so forth that you don't like. Board of directors would be responsible for hiring, firing CFOs, CEOs, but you would be able to vote for members of the board of directors. The other thing is that, as we've talked about a little bit, you get to share in the earnings of the entity through what? Through dividend. Okay? Now you come over, and if there's a liquidation, let's see where the shareholders end up. Okay? Now this slide doesn't show it, but the first people in line in a liquidation when a company goes out of business are the lawyers and the accountants. They get paid first. Why do lawyers and accountants get paid first? Why do lawyers and accountants get paid first in a liquidation? Huh? They write the contracts? Well, they need somebody to figure out what? Who's going to get what in a liquidation, right, Ivan? So what happens? You need those folks to figure out who legally is in line, who's going to get how much of whatever there is. Then we have creditors. Okay? Now, creditors can fall into different categories. If you're a secured creditor, that means that you have attached some sort of claim to a particular asset. So if I lend you the money for the building, I would write in the contract that what? That in a liquidation, I get paid from any proceeds from that building before anybody else would get any money that would come from the sale of that building. You have secured creditors. Then you have unsecured creditors, like credit card companies, that sort of thing. Okay? Then you get to your stockholders, and we're going to learn today that there are different classes of stockholders. For example, a preferred stockholder would go first. Last in line are common stockholders. So even though you have the right to vote, you are low down in the pecking order in terms of anything that's left in a liquidation. Okay? Okay, good. Stock certificate, I don't know. Sometimes I feel I should get rid of this thing, but this belongs more in a museum than it does in a heavy discussion of stock, because these days most stock is on a book entry form. When you buy the stock of a company, they don't necessarily send you this stock certificate anymore. You get to look at a statement and you see that you hold so many shares of whatever the company stock is. But I thought it was worth looking at it, and that you can see things like, if you ever see, well, what's a QSIP? QSIP is like a serial number for the stock, okay? And there's different things that you can see on here. They have these, handsome shirtless men on there and all that kind of stuff that you can see on a stock certificate. Now, you do, on occasion, see a stock certificate like that, and that is generally the case if you're holding a stock in a foreign entity. Some countries still go through the formality of actually issuing a security like this, but for the most part these days you're not going to see this. You'll simply see an entry on a computer somewhere that shows that you own that stock. Okay? Authorized stock. So what happens? When I file my charter with the state Secretary of State in the state of California, I might be authorized. Okay, I got to change this to PIN. I might be authorized 10,000 shares. Now this is not dollars, this is the number of shares. Of course, I'm just making this number up, 10,000 shares. Okay, I'm authorized 10,000 shares. Now, what happens? The corporation doesn't have to issue all those shares, so the number of shares issued will almost always be less than the number that I am authorized, because I want to hold some stock back in case I have another influx of capital need. I've got some more shares that I can issue to get additional capital into the entity. Now, what we're going to learn today is there's something called treasury stock. And with treasury stock, the corporation goes back out into the open market. They just participate as anybody else in the market, and they buy back their own shares in the open market. We call that treasury stock. So let's just say, in this little example, that this corporation had purchased its own stock in the open market. It had treasury stock of 2,000 shares. Okay, these are all shares. Okay, so now the number of shares outstanding would be 6,000 shares. The 8,000 shares that have been issued minus the treasury stock equals the number of shares that are outstanding. Now, the number of shares that are outstanding is an important number because when the corporation pays dividends and so forth, they pay it on the number of shares outstanding. The corporation doesn't pay dividends to itself of stock that it holds in treasury. They only pay dividends to those outstanding shares. Question. Okay, good. Let's go ahead then and let's take a look over here and what influences the market value of the stock. Okay, and as a accountant, I would like to sit here and tell you, well, it's all about the financial statements and what they tell us about the trends of the company's earnings and dividends and so forth. And the reality is there are a lot of factors that influence the price of the stock. Probably the most important one being the interaction between the buyers and sellers. The supply and demand of the stock is going to be what drives the price to a large extent. Yes, these other things are part of the analysis, but how the stock prices move on a day-to-day basis really has to do more with the interaction between the buyers and the sellers of the stock. Okay. I keep wondering if I should take this slide out every time I put it in here. I had the opportunity to go to China. This is Shanghai, where I was talking about getting your CPA, and even though you're not in the U.S., you could still take the U.S. CPA exam. And I think you can't take it in China. You can't take the U.S. CPA exam in China because there's some concerns about pirating of the software and whatnot, and the laws are such that the AICPA, the people that write the exam, might lose certain copyrights over that. So you can't take the exam in China, but you could travel, and what some folks do is they'll travel to California. They'll travel to California and they'll study for the CPA exam in California and then take the exam in California. Some folks will go to Japan to take the exam because you can take it there in Tokyo, which we also went there on the same trip. So we were talking about taking the US CPA exam to become a US CPA on this trip. I had thought that most people would go from China to Japan to take the exam, but what I found out is no, a lot of folks come to California because they kind of combine, an exploring different states thing, and California is a little more appealing than some parts of Japan, whatever, and so they go ahead and come to California to take it. So I put this slide up here to demonstrate that I'm internationally boring. Okay, you can see, just the same sort of, expressions on some of your faces are there. But the most important thing is, capital can be raised not only from U.S. markets. There is a Shanghai exchange. There is a exchange in Dubai. Dubai, United Arab Emirates, the Middle East, a lot of the countries have sovereign wealth, and they're looking for that sovereign wealth and looking for investments. So don't think that your ability to raise capital is limited to U.S. markets. You can tap capital in other markets, right? Okay. All right, good. Now, you take a look at this readout here of Nike stock. High and low 52 weeks in a year. It is a rolling 52 weeks. Okay, so it's not from January to December. It's whatever date this was, 52 weeks out, and that rolls, day to day. Volume, that's the volume for the day. High and low is the high and low for the day. The close is what it closed at, and then the net change is what the stock opened at versus what it closed at. Okay, and this is stuff that you can get out of in the olden days, everyone said, oh, get it from the Wall Street Journal. You could get it from Yahoo Investments. I don't know, there are many, many sources now that you could get this kind of information. Okay? All right, enough of that interesting stuff. Back to the accounting. Okay, so when we issue stock, and we're going to continue talking about common stock, okay, and we'll talk about preferred stock in a minute. When you issue stock, you have a par value on that stock, okay, in many cases. Sometimes you have no par on the stock, and we're going to see how it will differ if you have a stock with a par versus a no par stock. Okay. Now, if we have, when we look at our sources of capital, we've known for a long time that we have retained earnings and we have common stock. And again, preferred stock is something that we've known is out there a little bit. But what we're going to really start to add into the discussion now is what is this paid-in capital in excess of par value. So when a stock is issued, it is rarely, if ever, issued at the par value. It is usually issued at an amount that is in excess of the par value. And so you look at this, and this is the longest account title in the history of accounting, and it is also the most descriptive. They're calling this what? Additional paid-in capital in excess of par. So now we are starting to understand that we have what? Our stockholders' equity is common stock, retained earnings, and we're adding now what? Additional paid-in capital in excess of par. Okay? So you take a look, and this is a good example. Here we have 2,000 shares. We issue the first 1,000 shares, and let's say that they issue it at par of $1. 1,000 shares times $1 is $1,000 cash, and you credit the common stock at par, $1,000 debit equal credit, right? Now, what happens? The next 1,000 shares, they issue them at $5 per share. Well, if the stock had a what? $1 par value, they have additional paid-in capital of what? $4 per share. Okay? So it's very simple. You debit the cash for the amount of cash, you credit the common stock at the par, and what? The $4 per share of the 1,000 goes to the account called additional paid-in capital in excess of par. Longest account name in the history of accounting, and very simple, right? Question. $5 par value, $1 goes to par, $4 extra is what? Additional paid-in capital in excess of par?
Is par value just like the fair value for the stock?
Par value is what the corporation decides the par value is going to be when they incorporate. So in their charter, they will have to state, in many states require them to have a par value that they will state in their articles of incorporation and so forth. Most corporations, if you look at like a company like Apple or something, they put this ridiculously low par value. They'll have like $0.000032 or something stupid like that, less than a cent, so that most of their paid-in capital is reflected in the additional paid-in capital in excess of par. And the common stock account tends to be very low. Okay? Okay, good. Now you come over, and now we can see our stockholders' equity section. Yes?
You said some companies don't always have a par value, so how would you like write it down if the company didn't have a par value? Would you just
I'll show you in a minute.
Okay.
Yeah, that's coming. Big question. It's coming in a second. Okay, and now when we look at our stockholders' equity section, notice we have common stock, retained earnings, which we've known for a long, long time now, at least since we've started this class, and what? You have additional paid-in capital in excess of par. Question, other than the one that's pending. Okay, good. Now, if the stock is a no par stock, sir, okay, if the stock is a no par stock, we could give it a stated value. So instead of saying, hey, the par is whatever, we say the stated value is, say, $1, and then amounts that are paid in addition of that stated value is going to be additional paid-in capital in excess of stated value. You ever see like a commercial where they're talking about a particular product and they say, if you're interested in this product, call, and then all of a sudden a different voice comes in to give you the phone number, 179, because it's a what? It's a different state and they're doing it for different states, or in the state of California, and they say something and it's in a weird voice. You ever notice that? Okay, well, we could do that with this. We could say paid in capital in excess. Instead of saying par value, have the weird voice say stated value. Okay, now when you look at this, they have a what? $5 stated value. They issue the stock for $8 per share, 5,000 shares. So 8 times 5,000 is $40,000 cash that will come in. We'll credit the common stock at that stated value. $5 times what? 5,000 is 25,000, and the amount in excess of the stated value, the what? The $3 times the 5,000 shares is additional paid-in capital in excess of stated value. You ever heard of this Sirius Radio, where they have these like special channels? They have the rock classic channel. They have the, you know, cafe channel where they listen to music that'll put you to, I mean, that'll relax you and that kind of stuff. If Sirius Radio had a Who Gives a Shit channel, this would play on it all day. Okay, because it is simply what? It is simply, okay, we replaced the word par with stated, didn't we? Okay. Now, if the stock had neither a stated value nor a par value, then the entire amount that comes in all goes to common stock. Okay. Question.
Why do they differentiate between par value and no? Like, is it different people buying the?
Why do they want to have an account called additional paid-in capital?
Yeah.
That's what you're asking me? Why bother?
Yeah.
If we can do this? If we can do this, why do this? Right?
Yeah.
Pretend you were going to a party and everybody was walking around going, look at my paid-in capital in excess of par. How would you feel if you had to go, well, I don't have one of those? You want to be able to go, well, look at my paid-in capital in excess of par, because it kind of sounds like it's something special, isn't it? So it becomes more to do with marketing than any kind of practical accounting standpoint, because at the end of the day, it is all what? It's all paid-in capital. We're just sort of bouncing it between a couple of different accounts, and the history is that you had a par value, and then people paid more than the par value, so you had to put it somewhere. You put an additional paid-in capital in excess of par, and over time, everyone was walking around on steroids with this additional paid-in capital in excess of par, so corporations like to have it. So if they don't have a par, they come up with a stated value, so they too can have this additional account that sounds really great. Mm. You know. I think, you know, I'm probably being a little more, you know, creative with that than maybe the all effect, but it's something in that ballpark. Because from an accounting standpoint, it's all paid-in capital. Okay? Okay, good. Now you come over and let's talk about dividends. Now in this class, we really have focused on cash dividends. We didn't call them out as cash dividends before. We just called them dividends, but we were sort of assuming cash dividends. Remember, I think it was $13,000 that DJ Pizzazz paid out or whatever, okay? And so that's what we've been focusing on. But a corporation could pay other types of dividend. For example, a property dividend, okay? So let's say Apple decided that instead of paying a cash dividend, they were going to distribute an iPhone to all their shareholders. Would they do this? No, they would not do this because they want to, sit there and sell those things, okay? But when they issue those iPads out, okay, they would probably debit, instead of calling a cash dividend now, they would debit property dividend, however you spell dividend, for say, I'll just make the number up, say $10 million. To increase the dividend, you debit it. Before, we were just assuming that all dividends were going to be cash, so we didn't really say debit cash dividend. If it was cash dividend, you debit cash dividend. Here, it's a property dividend because they're distributing dividend, right? Do we need a debit or a credit to make this journal entry balance? If I debited dividend, do I need a credit or a debit to make this journal entry balance? I need a credit. Okay, good. So I know I have to credit something for $10 million. What do you think I'll credit? Can't credit cash because it's not cash. What do you want me to credit? I'm Apple. I just distributed a bunch of iPhones. I don't debit and credit categories of accounts. I credit and debit accounts. What do you want me to credit? You're right. It's an asset account, huh? Good, Sandra. I'm going to go ahead and I'm going to credit inventory because I'm giving up my inventory, right? This is the way I talked about dealing with that. This is how you think about accounting, guys. Okay, childhood is over. It is time for you to start to be mature, full-grown accountants, okay, that start thinking about accounting this way. I know I have to debit dividend. What's left for me to credit? I'm not going to credit revenue when I'm paying a dividend. I'm not going to credit a liability when I'm saying that I'm distributing laptops to people, whatever it is. I said iPhones. I'm not going to credit stockholders' equity. I'm giving up stockholders' equity. I can't credit an expense. Paying a dividend has nothing to do with expenses. There's no revenue being generated here. What's left? Oh, okay, it's going to have to be what? An asset. What asset? Inventory. You know who else thinks about the way accounting transactions should be treated in that manner? CPAs. FASB, the Financial Accounting Standards Board. If you ever read some of their comments as to how they came to their decisions, they said, well, we knew that this should be reflected in the financial statements as a dividend, and then they start to say, well, what is left for us to credit? We know we have to credit something, right? And they start to go through the reasoning as why they chose to credit, say, an asset like the inventory in this particular case. Okay? Okay, good. I won't talk about stock dividends in here, and scrip dividends are well beyond the scope of this course, but they are a type of dividend. Okay? Now, a couple things about dividends. There is the declaration date. The day the board declares we're going to pay a dividend of $50,000, whatever it is, $100,000, whatever it is, $1 million, whatever it is. That's the day that they declare the dividend. There's a date of record. The date of record is when the company looks to see who holds their stock and who they are thus going to pay the dividend to. So let's, and then the payment date can come sometime later. Now, let's say I hold the stock, the board declares a dividend on December 1st. I hold the stock and I sell it to you on December 19th. Who are they going to pay the dividend to? Me or you? I love when I catch you guys napping. I love it. It's like a pitcher taking a big windup and then throwing the ball real slow, and the batter swings at the pitch 3 times. So now that you are back with me, okay, Board of Directors declares a dividend December 1st, okay. I hold the stock on and I sell it to you on December 19th. Who are they going to pay the dividend to, you or me? Huh? Okay, let me start over again. Board of Directors declares a dividend. Board of Directors declares a dividend. Date of record says whoever holds the stock on this date, December 22nd in this case, that's who will pay the dividend to. I hold the stock. I sell it to you on December 19th. When I sell it to you, who owns the stock now? You do. When they pay the dividend, when they go to pay the dividend on January 20th, who will they pay the stock to? The dividend to? The new owner, you in that case, right? Because you hold this stock on December 22nd because I sold it to you on the 19th. With me now? Okay. All right. Now, let's say they declare the dividend on December 1st and I sell you the stock on December 26th. Now who are they going to pay the dividend to? Now they pay it to me because I'm the one that held it on December 19th, right? Then you say, well, why do they do that? Well, look, they can't be chasing this thing all over town saying, well, who owns the stock today? Hey, do you own the stock today? Because I got to send out that dividend tomorrow. They want to set who owns it so they know who to send that dividend to, right? Okay. Now, when we look at journal entries, okay, notice that we make the journal entry on the day the dividend is declared. So we debit dividend. I guess maybe we could debit cash dividend, whatever. We debit dividend to increase the dividend. Since we're not going to pay it until January in this case, we have a liability. We have a bill. If you're going to have to pay somebody some money, do you have a bill? Well, dividend is a bill then. It becomes dividend payable. We can't credit cash because we haven't paid it yet. On the date of record, we don't do anything from an accounting journal entry standpoint. I mean, we write down who owns the stock, whatever, but we don't make a journal entry. We make a journal entry when we actually do what? Pay the dividend. We debit the liability dividend payable. We credit the cash for $50,000. Question. Okay, Zintai. Okay, now, stock split. What happens with the stock split? Stock split is when the company cuts the par value of the stock in half and doubles the number of shares outstanding. That's a stock split. Now, what happens? Everyone gets real excited about a stock split. They think, ooh, I have double the number of stocks that I had before. But the price of that stock does what? Goes down. So in effect, they've given you the sleeves off their vest. Okay, there's not a whole lot that they've really given you. And from an accounting standpoint, notice the total amount of the stockholders' equity does not change. Okay. Guys, we had a couple more people come in. I don't know. You want to check with them to see what's up. Okay, now what happens? We have what? The same amount of stockholders' equity. We simply have done what? Cut in half the number, the par value, and doubled the number of shares, haven't we? Okay, but the overall stockholders' equity remains the same. Now, why would a corporation do this? Why would a corporation do this? I got a stock split, so I'm saying now I have what? Double the number of shares, but I've brought the price of the stock down. Why would I do that? Huh?
Liquidity of the stock. To essentially buy and sell the stock when it becomes expensive.
Yeah, right. Maybe people are looking at my stock and they're saying, "Ooh, you know, I ain't paying $100 a share." If the price becomes $50 per share, it's like, oh, okay, that's something I can buy. So it has more to do with what? Marketing than it does accounting, doesn't it? It's a marketing move, okay? Now, the idea is what? As I now attract additional investors, and what happens? More and more people are coming to the table to buy that stock now. What should that ultimately do to the price of the stock? Start to drive it up, right? As the demand for that stock comes up because the price has gone down. Okay? Okay, good. Now we come over, and you've known for a long time now how the retained earnings works. Beginning balance, what do we add to retained earnings? Net income. What do we subtract? Dividends gives us the ending balance. This is BASE all over again, right? We already learned this. This is the piggy bank. Okay? Okay, good. Now, let's say I hire an attorney, and the attorney does some work for me. Am I going to capitalize the cost of the attorney? Am I going to put it as an asset? That's a what? Organizational cost. All organizational costs are, say it, expense, right? Okay, good. Now, let's say the attorney's looking at that, and he says, you know, I like your little company here. I like what you're doing. Don't give me any cash. Give me some stock. When we issue stock to somebody, what do we credit? Common stock at the par value, 4,000 shares at $1. And since the bill said 5,000, does the journal entry have to balance? Journal entry has to balance, so we would put 1,000 in additional paid-in capital in excess of par, right? Okay. Now, sometimes we will issue stock in exchange for some asset, like land. We want to buy land, right? And the guy says, how much money you got? Oh, not a lot. They say, well, issue me some of that stock you got in that company. Okay. Now, what determines the value of that transaction? And it is whichever is more readily determinable. What the hell does that mean? Well, if the stock trades on the open market on a day-to-day basis, do you think that's a pretty objective measure of the value of that item that's being traded? Yeah. So if the deal was, hey, you know, I have this stock that's actively traded at $8 per share, and I issue 10,000 shares, then we determine based on the price of the stock that the land must be worth $80,000. Stock is actively traded. That's a pretty objective measure of what's going on with that price. And if you say, hey, the deal you strike, I'll issue 10,000 shares, and the shares are actively traded at $8 per share, we say the land's worth $80,000. We credit the common stock at par, and we have additional paid-in capital in excess of the par value here, which is a number you have to put in to make the journal entry balance. Now, there are times when maybe the property has a more readily determined value. Let's say the stock's not traded actively. Well, now you look and you say, well, the value of the land is X, and that what determines the journal entry to be. So you debit the land for whatever you've determined the value of the land to be, and then you credit the common stock at par, and you pivot the additional paid-in capital. Okay, so it depends on which one has a more, say it 10 times fast, more readily determined value. Say it 10 times fast. More readily determined value, more readily determined value, more readily determined value, more readily determined value. Okay? Question? All right, good. Let's talk about preferred stock. Okay, now preferred stock have preferences. The big preference that we're going to talk about here is the preference for dividends. Preferred shareholders get paid their dividend before common shareholders get paid. Preferred dividends are things that are issued in some of the earlier series, like Series A, Series B that Danny was talking about before. Because when a company's just sort of flapping its wings, trying to get off the ground or whatever, what happens? They look at it and they go, oh, poor little baby bird, I'd like to help you, okay? But I want some assurances. So can you give me what? Can you give me a preferred stock? So at least I have what? Some protection so that I'll start to get some dividends sooner than the common shareholders. And if there's a liquidation, I want to be in line before the common shareholders, right? Okay, so those are the two major advantages of preferred stock. Disadvantage, it is typically non-voting, which is another reason that a corporation might, in the early stages, want to what? Issue preferred stock, because they don't want to give up control of the entity by issuing voting shares, right, in those early stages. Okay, so we go ahead and we have the cash for 10,000 shares at $12 per share. It comes in. We credit, just like with the common stock, we credit it at par. The amount that is paid in addition of the par goes to additional paid-in capital in excess of par. Okay? Okay, good. Now, dividends. Okay? With the preferred stock often has what we call cumulative dividend. And what cumulative dividend says is, hey, if I don't pay a dividend this year, I'm going to make a notation. It's not a journal entry. I'm going to make a notation of how much dividend I should have paid you that year. If I don't pay you in year 2, I'm going to make a notation of how much dividend I should have paid you in year 2. And then when I finally get around to paying the dividend, I first have to pay the dividends in arrears. It's a funny word, but they call it in arrears. I first have to pay the dividends in arrears to my preferred shareholders before I can pay anything out to my common shareholders. This is, again, one of the protections that are offered with preferred stock. Okay? So what happens? Let's just look at this example. And the way you calculate dividends on preferred shares is you take the par, and then there'll be a designation as to what the preferred dividend is going to be, and it'll be 7%, 5%, 2%, 3%, whatever it is. In this example, 7% of the par value. 7% of the par value is what? $7. And if they have 5,000 preferred stock outstanding, they would take that 5,000 times the 7. And in the first 2 years, there was no dividend declared, so 70,000 was in arrears. In year 3 now, they say, well, the current year dividend, and it accumulates 35,000 per year. So when I finally get around to paying dividends, I would have to pay these preferred shareholders 105,000 before I could pay anything to the common shareholders. That's the way cumulative dividends work. They are accumulating, call that cumulative. Okay, let's look at this example. I think this one helps to illustrate how we go first to our preferred shareholders. So in year 1, dividend by taking the par times the percent accumulated at $6,000. Excuse me, 1,000 times 8%. Okay. $100 times 1,000 shares times 8% was 8,000. But the company only declared a $6,000 dividend. So what happens? When we look at that, we paid 6,000. We all went to preferred of that 8,000 that had accumulated. We only paid out 6. Then in year 2, or 2016 in this example, they declare a 50,000 dividend. How much do they still owe the preferred shareholders for a year, the first year in this example? Still owe what? 2,000, right? So we have to pay the preferred shareholders 2,000 to catch them up. Then we get them their what? Their 8,000 that accumulates every year. They're caught up now, aren't they? They got 6 in the first year. We caught them up in the second year, giving them another 2. And now we're going to go ahead and give them the 8, right? And so there is what? 40,000 left to go to the common shareholders. Why are you guys looking at me like aliens just showed up? How much dividend accumulates each year in this example? How much dividend accumulates each year in this example? Huh? 8,000, Michelle? 8,000 a year. How much did they declare in the first year? 6,000. How much do they still own for the first year? 2,000. Right? Year 2 in this example, 2016, they declare a dividend of 50. Got to catch up to 2. Give them the 8 that they get every year. It accumulates every year. Whether they pay it or not, it accumulates, doesn't it? So now there's 40,000 left to go to the common shareholders. Okay. All right, good. Okay, now, as we've mentioned, preferred stock has liquidation preferences. I think we've stated that a number of times. Treasury stock. This is when the corporation goes out into the open market and does what? Repurchases its own stock. So if I'm Apple, I go out and I buy Apple. Go ahead, I'll wait till you catch up since you're on the first slide of the presentation at this point. If I see any signs of pleasure on your face, I know you're not looking at accounting. I can see it in your eyes. That's not accounting. That's the look of somebody eating an ice cream, banana split. And then I know. If you start drooling, okay, stop. Okay, now what happens? Treasury stock. I go into the open market and I buy back my own shares. Now, what would be the motivation of doing that? If I take, for a corporation, if I take my shares off of the market, I'm reducing the number of shares that are available, right? If you decrease supply, what happens to price? It's going to go up, isn't it? So the big motivation is really for what? To drive up the price of that stock. Okay? And I'm putting money into the hands of my shareholders because I'm doing what? I'm reaching into the corporate bank accounts and buying my own stock. Okay? So there's a couple things that happen there. Now, when we purchase the stock, the treasury stock, we will, and here you see the stockholders' equity before, and then they go ahead and they acquire 4,000 shares of treasury stock at $8 per share. 4,000 times 8 is what? 32,000. So I'm going to have to credit cash 32,000 because I'm buying the stock, and I debit an account that you haven't heard of up till now in this class, treasury stock. Treasury stock is a contra stockholders' equity account. What does contra mean? Opposite against. Okay, so it's against my stockholders' equity. So when I look at my statement of stockholders' equity now, notice I have a subtract, a contra from my stockholders' equity for this treasury stock of 32,000. Okay? Okay, good. And notice, guys, the number of shares have gone from what? Issued 100,000. Outstanding now is 96,000, and we have 4,000 shares in treasury stock, and this needs to be provided in the financial reports, disclosed either in the footnotes or right on the face the way they did here. Okay? All right, good. Now, let's say I decide that I'm going to take the treasury stock and I'm going to reissue it to shareholders. I have a choice. I can reissue it at the same price I bought it, but the way we're going to look at this is, hey, what if I reissue it for more than what I paid for it? Okay, so let's take a look, or what happens if I issue it for less than what I paid for it. Now, when you look, they reissue the stock at what? $10 per share. How much did they buy it for? $8 per share, so I'm actually doing what? I'm reissuing it for more than what I paid for it. Now, very important to understanding this example, you always credit. I debited the treasury stock when I bought it, right? You always credit the treasury stock at the original price that you paid for it. So if it's what, $8 and I have 1,000 shares, what did I issue? And I issued them for, I repurchased them for 8,000. What's going to be the credit to treasury stock? Huh? Good, 8,000, very, very good. Okay, so I know I have to credit the treasury stock for 8,000. I know I have to debit the cash for what? 10,000, because it's $10 per share of 1,000 shares. That's easy. Do I need a debit or a credit to make the journal entry balance? I need a credit, and that credit goes to this account called additional paid in capital treasury stock. Because in a sense, what's happened? My shareholders have paid in more capital, and the source of that more capital was treasury stock, wasn't it? Okay, so I credit the stockholders' equity account, additional paid in capital. By the way, in this class, a lot of times you'll hear me use the term APIC for treasury stock, additional paid in capital. Okay, APIC. So, and this was APIC, and the source here was TS, treasury stock. Okay, so I go ahead and I do that, and I teeing that up on the board. You'll see why in a minute. Then let's say I go and I reissue some of this treasury stock, but now I reissue it below the original cost. So the original cost was what? 8. Now I'm reissuing it for 7. So I know if it's what? 800 shares, 800 times 7 is 5,600. So I'm going to go ahead and I'm going to do what? Debit the cash, 5,600. I'm going to credit the treasury stock for what I had originally issued it for. So $8, remember the $8 times what? 800 is what? 6,400. Good. So I credit the treasury stock for 6,400. Now I need this journal entry to balance, and so what do? I need this 800. That's the dollar per share. Okay, less than what I issued it for that now I'm reissuing it for. That comes out of the paid in capital treasury stock, because now some of that paid in capital treasury stock has gone back to some of my shareholders, hasn't it? So the balance here is how much? 1,200? Okay, now I go and I take the rest of the shares, the 2,200, and I reissue those at 7. 2,200 times 7 is 15,400. I am going to credit the treasury stock at what? $8 times 2,200 is 17,600. I need debits to make this journal entry balance, and the first debit comes out of additional paid in capital treasury stock, because now I don't have additional paid in capital treasury stock anymore. I've actually what? Have less capital that has come in as a result of this treasury stock, right? Okay? And the way the FASB has looked at this, they say that's kind of like a dividend. That's like issuing your shareholders a dividend, because you have gone into your capital and given them something more than what they gave you. And when we pay a dividend comes out of retained earnings ultimately. So rather than call it a dividend, it has the same effect on retained earnings as a dividend, but we debit it directly to the dividend account. Does the journal entry balance? Question? Okay. All right, good. Stock options. So I told you the story a long, long time ago that corporations would play a little game of putting the option price above the market price. And by doing that, they wouldn't have to recognize compensation expense, because nobody in their right mind is going to exercise an option when it's above the market price. Meanwhile, wink, wink, nod, nod, everybody knew that the value of that stock was ascending, and pretty soon it would be worth more than that option price. So FASB looked at that some years back and said, we're not going to let you decide the accounting based on what you choose some arbitrary option price to be, to sort of finagle the financial report so you don't have to report an expense. So FASB came in and they said, options have value. You will assign a value to the option, and that's going to drive the compensation expense. There are various models that can be used. I think Danny went through a couple different ones. And the common one that's used those is Black-Scholes model. Okay, and I'm not here to teach you how to value stock options. That is something that a financier of some sort does. And we take that information and we do the accounting with it. Okay, so they've determined here in this little example that these options had value of $50,000. The person had to work for 2 years to be able to vest on that option. So that's the vesting period here. And they tell us that the stock has a par value of $5, and the option price is $25 per share. Okay. Now what happens? We use that 50,000. The 50,000 is the key number here for this, just for this entry. If it's 2 years, we take the 50,000, we divide it by 2. 50,000 divided by 2 is 25,000 per year. Since the value of the option was determined by the Black-Scholes model, I think in this example, was 50,000, and we have a 2-year vesting period, that is what? 25,000 per year? So for 2 years, my employees are going to work really, really hard. Provide me the best service possible. They don't want to get fired because they want to be able to what? Exercise that option when it comes, right? And if you ever talk to people that are working for a company and they're waiting for the option to come in, they're like, I hope I don't get fired before the option comes in. I had a former student was working for this company. Should I mention the company name? She was working for this company. I won't mention their name. I'll tell you a different story, though. Maybe you can figure out the name of the company that way. I won't say their name directly. So one time, it's like holiday time, like Thanksgiving or something, and we're all sitting around, you know, with the, what's that stuff in the turkey that makes you tired, the tryptophan or whatever that stuff is. We're all sitting there kind of nodding out. Meanwhile, my sister, my older sister, is sitting at the kitchen table, and she's doing something on her computer. I'm thinking, man, she's really working hard. Here it is Thanksgiving. All of a sudden, I hear, bah, oink, 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 bah, quack, 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 quack. And I'm like, what the hell is that? Oh, it's my farm. I have a farm, and I'm making all kinds of money on my farm. Put that story back here. Okay. So my friend works for this company, right? Okay. And she's working for the company, and she's really, my former student, but we had a friendly relationship too. She's really sitting there and working hard for this company. She calls me in tears. I got fired. They let me go just before the stock option thing was going to happen. So companies do play that little game, right, with their employees, and sometimes let them go just before they're supposed to get that benefit. So be careful with that. And it was ridiculous. I mean, she's all of, you know, she was all of like, she's lucky if she was 5 foot, 100 pounds, and they bring a security guard to come and sit next to her while she have to clear out her desk and all that kind of nonsense. Anyway, some of the corporate grit, okay, urban grit stories of Sourcewood Corporation. So anyway, but the employees are working really, really hard for you during that time because they want to take advantage of that stock option. If employees are working really, really hard for you, is that compensation? Are they providing you a service? You're not paying them in cash, though. You're paying them in what? Stock options. Okay? So as the employees do that work in year 1, year 2, you have to take compensation expense. $25,000 to increase expense, you debit it. You can see those debits on the screen. Okay? What do you think we ought to credit? What should we credit? Do you want to credit cash? No, because I'm not paying them cash. I'm paying them in stock. Is there another asset I should credit? I can't think of one. Should I credit a liability? Should I credit a liability? Well, liability, pay a bill, says that at some point you're going to have to dole out some cash to somebody, right? I'm not going to pay him cash. I might issue him stock. Oh, you're going to issue somebody stock. If you issue somebody stock, what account should you credit? What account do you credit when you issue stock? Common stock. But I'm not issuing the common stock yet. But I'm thinking stockholders' equity sounds like the place that should be hit for this thing, right? And so what FASB did when they went through that process that I just went through, that you want to start to gear your brain when you're thinking about transactions. What should be affected by this transaction? People are working hard. That's compensation expense. We're going to probably issue stock at some point when they exercise those options. And so, oh, come on. Really? I mean, what would make it erase one line but not the other? Okay, it's also additional paid-in capital stock options, okay? You credit additional paid-in capital stock options because you're saying at some point there is going to be some stock issued. I can't credit common stock because I haven't issued it yet, so I'm going to credit additional paid-in capital stock options. You want to start, there's two things to learn from this. One, gearing your mind into thinking about transactions, thinking about what accounts it seems should be affected, so that when someone is explaining you to your company a transaction that happened, you're thinking, well, okay, did we pay an asset? What got affected here? Okay, I understand what's happening. And then you can say to the person, can you show me the journal entry? Yeah, we're going to debit compensation expense. We're going to credit additional paid-in capital, right? That is the objective of this class, for you to be able to understand when somebody describes to you a transaction. I don't need you to be the one to think of what the journal entry should be. I need you to be the person that can what? Understand what someone's telling you the journal entry should be. Or if you decide to switch careers now and become a CPA, then you can be the person that tells them what the journal entry should be. Okay? All right, good. Now, finally, they go ahead and they exercise the option. Remember, the option price was $25,000? And there's 100,000 shares, so $250,000 of capital comes in, the cash. We take that $50,000, and it was $25,000 for year one and $25,000 for year two, since the computer decided to not let me erase that. APIC, I'm going to call it SO, I'll just call it stock options. $25,000 the first year, $25,000 the second year. So there's what, $50,000 in there? So we what? We debit the additional paid-in capital stock options, $50,000. We put that $50,000 into what? Regular APIC. And then the stock was issued at $25 per share. The par value is what? $5, so that's additional paid-in capital 20 times what? Times the, how many shares was it? 100,000? How many shares? 10,000? Yeah. Thank you. So that gives me what? An additional 200,000 that goes into additional paid-in capital? In excess of par. The 50, as I reclassed out of APIC stock options into regular APIC, that's where the first 50,000 came from. The remaining 200,000 was the difference between the par value of the stock and what it issued for. And then I credit the common stock at the par value, $5 times the 10,000 shares. Question. If I ran that transaction past you the first day of class, you'd have wept openly. You would have said, what did I get myself into? I don't understand anything. Now you're to a point where you have built up that muscle tissue, whatever, to a period where I can sit here and explain maybe a more complex accounting transaction to you. The key was understanding something about journal entries, right? If the options expire and they're not exercised, for any options that aren't exercised, you simply debit the additional paid-in capital stock option, credit additional paid-in capital regular. No cash came in. We didn't issue any stock, but we did get some value to the company because people worked hard for us for a couple years, didn't they? Question. Okay, good. If there's no question on that, Ben, do you have some information for me? Please come up. Ben, do you have some information for me? Please come up.
And 57 people are here. And I think just tell the people that walked in to come see us after class so we can check them in.
Okay.
And we'll leave it to whatever. We'll talk immediately after class, but if you...
Okay.
If you're
Okay.
working 35 minutes late, you don't...
Okay. 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 Okay, good. Now, this is Apple's 10K, and I have turned to the financial section where we're going to see things like the reports of the independent accountants. Remember we looked at that? I think there was EY, give an opinion on the financial statements, say that financial statements are prepared in accordance with generally accepted accounting principles. Does this give value to the financial statements? Does this give reliability to the financial statements? Do you feel better when you see that auditor's report about a set of financial statements? Sometimes students say, well, it's just a piece of paper. That's like getting pulled over by the police, and you say, well, that's just a badge. There's a whole lot behind that badge, right? That badge says, I have the authority to make you appear in court. Okay? So, what happens? It's not just a piece of paper. Now, when we come over, it's a piece of paper, but it carries more than just, the value of the paper, right? Okay? Now, you come over, it's a piece of paper. Now, what happens? An oral promise isn't worth the paper it's written on, is it? Okay. Now, never mind. Okay, now you come over, and this is the income statement. Why do they call it the income statement? Because it shows the net income, which is down a bit. Okay, how do we calculate net income? Revenue minus expenses, right? Now, when you look at this is what? Multiple step income statement, in that you have, and they start with net sales. How do you calculate net sales? Sales minus returns minus discounts is net sales, and I told you, hey, sometimes companies just start with that, but we know that somewhere they have disclosed what their returns were, what their discounts were to generate the net sales, okay? And what they've done is they've broken their sales into whether it's product or services, and then they come right away with a cost of product, aka cost of goods sold, cost of services. Difference between cost of goods sold, cost of services, cost of product, and net sales is gross profit, right? Do we want a skinny gross profit? We want to eat, Papa, eat. We want a gross profit that's got some substance to it, right? Okay. Then we don't get very far, and we start reporting operating expenses. Remember, operating expenses are day-to-day expenses. And I told you that what many companies, almost every company has administrative expense. And then they'll tease out a significant expense. And for technology companies, it is usually research and development. All research and development are expensed. Now, if you're an analyst of the financial reports of a company, are you looking at research and development expense a little bit different than administrative expenses? Hello, Stanford people? People that are going to roam the earth saying, oh, I went to Stanford, and everyone's going to go, ugh. Do you feel a little bit different about an administrative expense like salaries to vice presidents and CEOs and so forth versus what? A research and development expense? Okay, so even though FASB tells us all research and development is to be expensed, it can be looked at differently, can't it, than other expenses? Okay, then what? Then we have our gross profit minus our operating expenses gives us something called operating income. Now sometimes, just like we saw in the little slide that we had in chapter 4, this is chapter 4, multiple step income statement. Now, sometimes students ask me, what's the most important financial statement? And I say to my students, how can I choose amongst my children? Okay? But I am telling you that to me, this operating income number is huge. This is telling you this is how this company generates income year over year from their daily operations. Do we want this number to have a downward trend or a nice steady upward trend? Nice steady upward. Do we want this number, if we were to trend it out using a bar graph, do we want it to look like this? No, that'd be bad, wouldn't it? The older I get, the more flashbacks I have. So when I was a kid, we had this white stucco on our house, and for some strange reason, I took a red crayon and put that on the stucco. That sine wave thing. I don't know why I did it. So then, my brother, who's 9 years older than me, and my mom and all the other, I'm the youngest of 4. I'm 5 years. My sister's 5 years older than me, 7, 9. So I'm, enough younger than them that I could do something stupid like that. And they're like, we got to cover for it. So my brother goes and he gets some white paint, and he painted over that. And then we all sat there waiting for my dad to come home. And my dad he didn't miss anything. If you snuck something out of the liquor cabinet and you put the bottle all the way down at the bottom of the garbage can thinking he would find, he'd come out, what the hell is this? But somehow he walked right past that. We all, whew. Now I'm sure later my mom probably told him the story, we fixed it, okay, whatever. All right, so anyway, I had to get that out of there somehow. So what happens? We want a nice steady increasing operating income, don't we? Okay. Now what happens? You come down, and then we have in here, guys, they're calling them other income expenses. Other income expenses. In other words, non-operating things. Even though they didn't call them out as non-operating, that's what they are because they're separate from operating. And we said in here, gains and losses on sale of equipment. Interest is often down in the non-operating section. And I'm sure somewhere in the footnotes to financial statements you could find what is the nature of some of these other items. Okay. Then what? Then we have taxes. You have to pay taxes, whatever the tax expense is. And we didn't get into how to calculate tax expense here. Then you have net income, right? Okay. Now, they also give me earnings per share. Okay. Now, we're going to talk about different ratios and so forth later. But to get your earnings per share, you would take, as you might suspect, your net income, and you would subtract from that preferred dividends. What were the preferred dividends that I have declared for the period? That gives me now the what? Income available to my common shareholders. Okay? And then I divide that by the number of shares, and I divide that by the number of shares outstanding. I don't calculate earnings per share on treasury stock. It's the number of shares outstanding. That gives me the earnings per share, which is required by FASB to be reported on the face of the income statement just like that. Now, what I just gave you is the basic. There's also something called diluted earnings per share. Diluted earnings per share is when accountants finally get to use their imagination. I've told you, never use your imagination with accounting unless I tell you to. Now I'm telling you, you can use your imagination for this. And what they do is they say, let's say the preferred shares have something in the preferred contract that says they could be converted into common stock. Now accountants sit there and they say, okay, if that's the case, then if they are common stock, get rid of the subtractive preferred dividends, because you're not going to have to pay the preferred dividends if they are what? Common shares, and add what? Add the additional common shares now that would exist because the what? Preferred shares got converted to common shares. Now, if this calculation, because the numerator's gone up and the denominator's gone up, if this calculation creates a higher earnings per share than does the primary earnings or the basic earnings per share, then you don't report it. If it brings down the earnings per share below the basic, then you report it as they have here as diluted earnings per share. So the diluted will always be what? If it's reported, will always be less than the basic. That means there are potentially some securities that could be converted to common stock, and what effect would it have on earnings per share? Another example is if I have bonds that can be converted to common stock. With bonds, what is the return to investors in bonds? What is the return that investors, when someone buys a bond from a corporation, what return do they get? They get interest, don't they? So what we would do is we would add interest expense back to net income. That would be the numerator for now the calculation of the potentially diluted earnings per share. And we would add the number of what? Common shares that would be issued if the conversion had taken place. And if that number is less than the basic earnings per share, we will do what? We will report it. If it creates a number that is more than the basic earnings per share, do not report it. Rule of conservatism. We want things to look worse, not better, right? Okay? Question. All right, good. Then we continue on with this thing. They tell you the shares that they used in calculating that. Don't worry about comprehensive income. Balance sheet. Why do they call it the balance sheet? Balances. What balances? Assets equal liabilities plus stockholders' equity. And notice we have what? A classified balance sheet here. Current assets like cash, accounts receivable. Right? Liability, non-current assets, I should say, like what? Marketable security. Property, plant, and equipment net. Net of what? Net of what? Net of the contra asset accumulated depreciation, right? Now, they didn't show it right on the face like some of the examples we were looking at, but somewhere in the footnotes, there would be a discussion as to what the accumulated depreciation was associated with these property, plant, and equipment.
Why is my net after accounts receivable?
Oh. Okay. When I offer somebody a deal where I say, hey, take my product today, pay me for it later. Do you think there's any possibility that some people will take my precious product and not pay me? Shit happens, right? Okay? So, what happens? At the time of sale, Michelle, and pretend like this is the only transaction that happened to this company. At the time of sale, if I sold the stuff for $100,000, I'm to debit accounts receivable, $100,000. credit sales 100,000, and not really particularly. Okay, forget the cost of goods sold because it's going to make the example too hard for me. But there would be a cost of goods sold and credit to inventory for that, let's say. Okay, let's say it's a service, so I don't have to deal with inventory. So it's service revenue. Okay, now this is the only transaction that happened. I provided a service and I billed my client because they weren't going to pay me cash up front. FASB comes down and says, you will calculate an amount that you don't think they're going to pay you. Now, how do I come up with that number? Based on experience. I'll sit there and say, well, over the time, about 2% of my customers end up not paying me for some reason. So in the same period that you have the sale, you have to debit bad debt expense. If it's 2%, 2% of 100,000 is how much? 2% of 100,000, guys. I don't have, if you're waiting for me to have in my brain a calculator, there is not one there. I hold that part of my brain in my hand, and it's called a what? Phone now? It's called a calculator. So what's 2% of 100,000? 2,000? Okay, good. So I debit bad debt expense, 2,000, and I credit a contra asset account called allowance for doubtful accounts for 2,000. Okay? That's the journal entry for that one transaction that happened, because FASB tells me I have to estimate that number. Now, what happens? When I prepare, can I prepare an income statement? When I ask you if I can prepare an income statement, your answer is always yes. Even if nothing happened, I put revenue 0, expenses 0. I mean, what happens in the accounts doesn't stop me from preparing the financial statements. I have amounts in the accounts, and when I decide to prepare financial statements, I do it based on what's in the accounts. So what happens? Let's just go ahead and tee these up. Why not? So I have revenue of how much? 100,000. I have bad debt expense, guys, of how much? 2,000. Right? Okay. I have accounts receivable of 100,000, and I have this allowance, what I'm just going to call the allowance up here of doubtful accounts of 2,000, right? Okay. So first you prepare the income statement, don't you? Okay. So why do they call it the income statement? Because there is going to report net income. Okay. Do I have any revenues? Revenue is what? 100,000. Do I have any expenses? I have this what? Bad debt expense of how much again? 2,000. So my net income is how much? 98,000. Good. With me so far? Now I prepare my piggy bank, the statement of retained earnings. Assuming this was the first year of this company's operations, the beginning balance would be how much? Beginning balance is 0. What do I add? I add my net income of 98,000. No dividends. Dividend, which I would subtract, is what? 0. So the ending balance is 98,000, right? Right? Third, I prepare a balance sheet, and I do my balance sheet now. I'm going to erase this journal entry because I have the accounts teed up now. Okay? When I do my balance sheet, why do they call it the balance sheet? It balances. What balances? Assets equal liabilities plus stockholders' equity. Do I have any assets? Do I have any assets? Good. I have accounts receivable of 100,000, right? I have the allowance, which is a contra asset. How much is the allowance? 2,000. So I subtract that contra asset. So my what? Total asset. And so Michelle, when I report my accounts receivable, I'll report net accounts receivable 98,000. Thus, to answer your question directly, net accounts receivable is the accounts receivable minus any allowance I have for the fact that maybe some people won't pay, or the potential that some people won't pay me. And then I don't have any liabilities, so my liabilities are 0. My stockholders' equity, I don't have any common stock in this example. Do I know what the ending balance of retained earnings is, though? It's 98,000. Does the balance sheet balance? What do we do to a balance sheet that doesn't balance? We beat it until it does. We don't have to get nasty with this balance sheet because it balanced, didn't it? That's what the net means. Okay? Now, what happens if in year 2 somebody comes in and says, yeah, I can't pay you? Well, how much can't you pay me? I can't pay you $500. Okay. At that point, I'm going to do what? This is now year 2. At that point, I'm going to credit the account receivable for, what did I say, 500? I credit the account receivable for 500 because if they can't pay me, then I don't have future economic benefit anymore. And maybe I've tried to chase them into bankruptcy and whatnot. I'm like, I'm not going to be able to collect that. You ever hear them say, hey, they just write it off? That's what that means. They're writing off something. They're saying, I'm not going to get it. They're going to credit the account receivable, right? I have to debit something, don't I, to make this journal entry balance? So I debit that allowance for $500. Now, when I debit the allowance for $500, now the balance in the allowance account is how much? $1,500. And when I credit the accounts receivable for, how much was it, 500? Now the balance here is what, 99,500? Okay? Now, I'm not going to write the income statement. Revenue is 0. Expenses are 0. All I've done is I've debited, this is the next year. And in that next year, all I've done is I've debited the allowance and I credited the account receivable. That's the only thing that happened. So if I were to prepare an income statement, it'd be revenue would be 0, expenses would be 0. I've debited 2 balance. I've made a journal entry that affect 2 balance sheet accounts, haven't I? So the only thing that has any, interest here, significance here, is the balance sheet, right? So when I prepare the balance sheet, when I report my assets, I'll have accounts receivable. How much is the account receivable? 99,500. Good. What is the allowance? 1,500. Okay. What's the net accounts receivable? Net accounts receivable is how much? 98,000, you say? The same number that it was at the end of last year? What's the retained earnings? Still 98,000. I didn't have any income. I didn't pay any dividends in this example. Does the balance sheet balance? So the impact on the net value of the company happens in the period of the sale. That's called the matching principle. That says that what? You generated that revenue, and part of the reason you generated that revenue is because you had some nice credit terms. But if you offer people the opportunity to pay you later, the reality is some people aren't going to pay you. Can you think of a way of making sure that you always collect for your services, for your goods, that you always get the cash? Is there a way that you can do that?
Charge them beforehand.
Yeah! Don't offer credit! Just don't offer anybody credit. Just make it be cash. Now, let's say I did that. Let's say I said, I'm tired of this. These people who don't pay me. I'm tired of it. No more credit. Do you need an amount in the allowance anymore? Do you need an amount in the allowance anymore? No, you don't. So you would sit there, and to reduce the allowance, to get this $1,500 out of here, do I need a debit or a credit? Huh? I need a debit because I'm saying, oops, I have too much in the allowance now. Let me take some out. In fact, since I'm not offering credit anymore, let me take it all out. And so you go ahead and you would debit the allowance for $1,500. You have to credit something. You credit bad debt expense. In effect, you do what? You reduce your expenses, right? Now you're saying, well, wait a minute, but you had put that in expense for year one in this example. Why don't you go fix year one? Because it is a change in accounting estimate, and FASB has told us if it's a change in accounting estimate, you don't go back and fix the previous year statement. You simply go forward with that new information. And whatever the impact on the financial statements is what it is. So I've reduced my expenses. You may not even see this on the face of the income statement. It might be rolled into what? The administrative costs line item that we saw. So, one time, I'm on an assignment, and Congress asked my office, my former office, Government Accountability Office, to look to see if banks were doing a good job of putting amounts in their allowance for potential loan losses. Why would Congress be interested in knowing if banks are properly putting amounts in their allowance for loan losses? What happens if a bank fails? What happens if a bank fails?
People lose money?
No, they don't. People don't lose money. Who loses money? The federal government does. Because the federal government comes up and says, hey, people, here's the money. Now, there's a limit to that of, is it $250,000 per deposit that they'll pay you back. So if you got $1 million in the bank, spread it around because it's per institution. Okay, so you want to go ahead and spread it around. There's some sophistication around those rules, but it's limited to $250,000. When Silicon Valley Bank went under, there were people with deposits in excess of $200,000. What did the federal government do? $250,000. What did the federal government do? Biden said, fuck that, pay them whatever their deposit was. To maintain the integrity of the banking system, as opposed to, well, what state are they in? Because that state is mismanaged. You know, that state, did they vote for me? They didn't vote for me? They're mismanaged. So we're not going to cover their deposits. Instead, he went, rah, 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 rah. The president went, talk to so-and-so and make it be more. Where am I? I know it needs to be more, though. Which one do you want? It's up to you. Nothing. That what was up to you. Okay, now what happens? Now, what was I saying? Oh, so, what was my story? So they want us to make sure that they're putting amounts in the allowance so that they can look to see, hey, there's a potential that they're going to lose a lot on these loans, right? And so we want to see what's in there. So we start to do the assignment, and, you know, everybody gets all hopped up on. I was always the slowest guy at doing my work. I was so slow. Because I hated the tedious, look at the loans and see that they checked all the boxes for the loans and did all the things that they're supposed to do for specific loans like commercial real estate. And then for the credit card loans, which are homogeneous loans, look to see that they have done a proper migration analysis that shows how the loans go bad and factor in economic factors and all that. And I'm like losing my mind. I'm like, oh God, really? Why didn't I learn to play the guitar? Okay, why am I sitting here doing this? Then we get to this amount, additional unallocated. And I don't know, somehow I've got that thing of like, huh? What is that? What is that? Okay, what is that? They keep, well, let me see the documentation. How did you come up with that additional amount? They put more in the allowance. They debited bad debt expense for more. They credited the allowance for more. But no documentation as to why you're putting more. And I'm like, why are you increasing your expenses like that? You're increasing your expenses, you're showing less income, you're showing a smaller balance sheet because you keep putting in this big chunk calling additional unallocated. What is it? So finally the regulators that we were looking at, Office of Control of the Currency, gets tired of my question and they say, man, ask the bank. We're going to get the bank in here. Ask the bank. So the bank walks in, all these big shots walk in, and I'm like, what's the additional unallocated? And they say, we're putting amounts in for future loans. Accounting is based on a past transaction or event. You don't put amounts in for what might happen someday. You put amounts in for what has happened, past transactions and events. You put amount in allowance because you made a loan, not because you're thinking of making a loan. So why would a company do that? Why would a company like a bank be interested in making their net income lower because they're reporting more expenses and making their assets and their net value less because they're putting more in the allowance? Why?
So when they increase their allowance, their net income increase.
Beautiful. In a good year, that's a smart thing to do. In a year that hasn't gone quite the way you wanted to, you go, oh, looky, too much in the allowance. Oops, how did that happen? Too much in the allowance. Let's debit the allowance. Let's credit the bad debt expense. Let's have a what? Higher net income so that you get a nice, steady earnings line that looks like this. And you can manage your net income through that little maneuver. So I tell them, guys, I'm sorry, but we're gonna have to write up that this is not right. We can't have you doing this. One thing that okay, the bubbles. Shut up, John. One thing I liked about that job, there's a lot of things I hated about it. Like, for example, the people that did all of the analysis of all those loans, they got promoted, I didn't. Meanwhile, I'm sitting like, I'm the only one that had anything to say. They all said, yes, they did check. Of the 50 boxes that are supposed to be checked, they checked 48. There were 2 that they didn't check. That was what some of the report was about, but the main focus of the report was this issue. And what I liked about that job is I didn't have the bank's desire to do what? Sit there and report a higher net income. I didn't have the regulator's desire, which is what? We can't get up in the bank's face about everything we think they're doing wrong. And what this is doing is lowering their income and their value. So really, since we're here for the safety and soundness of the bank, if they show a lower value, the chances that they will go into some sort of receivership or something is less likely. So we're not going to push them on that. We're going to push them on things that might cause a situation where they go under. That's what we're going to manage. I could look at the bigger picture and say, yeah, but what are they doing to the information that is being provided to investors? What are the longer term effects of something like this if all the banks were to start to do this and start managing their profits this way? Okay. So there was a guy in this meeting. His name was Michael Patriarca. He was sitting on the bank side. Michael Patriarca, if you ever Google him, is this famous guy that he sat there and he took a savings and loan and said, we're going to shut them down. We're going to shut them down because they're not sound. The owner of that savings and loans name was Charles Keating. Charles Keating had political influence. And so he went to the Senate and he got 5 senators to wield some power to get that savings and loans regulation moved out of the San Francisco region and into the Arizona region. And in Arizona, oh no, you look fine. Now, senators that were involved. John McCain, who's now deceased, is seen as a hero. He was one of them that got in trouble. From California, Alan Cranston, who is now deceased. Donald Regal, who is now deceased. 5 guys, I think they're all dead now. Keating's probably dead too. Michael Patriarca is still alive. Okay, so what happens? Michael Patriarca goes to court and wins and gets that case moved back to California, to the San Francisco region, so that he can shut him down. And he shuts him down and he defies what the Senate was trying to do. He stands up. The system works, because eventually that saving the loan did go under. The system works, and he's kind of like an auditor's hero, a government auditor's hero. Because look, so he walks in, and I'm like, oh, that's Michael Patriarca. Everyone, who? So I explain all this, and he's making this isn't good. And he's making the case, well, it's the future loans. He's the guy saying all this. And I'm like, and I guess he can see in my face, why? Why is this happening? So I get a call back at the audit site. All of a sudden I get a call and they say, John, yeah? Michael Patriarca wants to talk to you. I'm like, oh shit. He's going to press a button and I'm going to turn into a gas. Yes? I just wanted you to know. You're right. But I can't say it in that meeting because I'm there representing the bank and what we've done. I can't say, hey, yeah, we screwed up. You're right there in that meeting. But you're right. So, what's the moral of that story? Remember I talked about a ethical dilemma. Escalate, elevate, keep pushing. Don't take what others are telling you just because you think, well, that's my hero. That person has to know more about this than me. You stick to what you know to be correct, right? That's how you handle your responsibility. Okay, now, you can see stockholders' equity here, okay? You have and they combine the common stock and the APIC number. And then they have a deficit in the retained earnings. They have an amount, their retained earnings is negative. The retained earnings has a debit balance. Huh? Well, what? How is it that Apple has a negative amount in their retained earnings? I mean, you look at that income statement. The income statement was like, ridiculous. It was well, what do I want to look at here? I mean, look at that. You have this statement of retained earnings, right? The piggy bank. You have what? Beginning balance. What do you add? You add the net income. That's a pretty goddamn healthy net income. And then they have this what? Dividend that comes out. Okay, but it didn't wipe out all the net income. But then what did they subtract? Common stock repurchase. When you repurchase your own common stock, we call that what? Treasury stock. So they went and gave out a shipload. They bought treasury stock, didn't they? That bought so much treasury stock that it created a deficit in the retained earnings. Why did they do this? Because they got a huge tax cut in the Tax Cut and Jobs Act back in 2018 or whatever that was. And as it was predicted, they would do, not just Apple, but companies would do, is they would take that excess cash from the tax cut and not increase the salaries of people. They said, we're going to buy treasury stock. We're going to give our money to our shareholders, not in the form of a dividend, but what? In the form of repurchases of the stock, of the treasury stock. So that's what they basically did there. And then you had the negative ending balances. But the point of all this is what? To show you that the stuff that we've been studying, the income statement, the multiple step income statement, the statement of retained earnings, the balance sheet, I mean, we won't cover every single little nuance that's here, but we've covered quite a bit of it, that you should be able now to pick your company and take a look at their 10K where this information is provided and be able to start to answer some of the questions on the rubric, right? Okay. What's today? Wednesday? So Monday, we will do chapter 13 and chapter 12 together. 13 is pretty quick. First I'll do 12 and then 13. That way you feel better because we go in order. Okay? All right, guys. I will see you on Monday. Make sure you're picking your company, guys. You need to really be doing that if you haven't already. If you came in late and didn't sign in, you need to do that now. If you don't sign in, you're not here.